All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show, episode number 10. My name is Cyprian Francis, and with me, as always, co founder of Madison Trading House, Mike Patton. Good morning, Mike.
Good morning, Sip, and good morning, everybody.
Today is June 1st. Wow, summer already here, halfway through the year,
Right?
and coming off of a holiday weekend. I'm sensing like it's sort of a slow start. Not a lot of news pushing things, a lot of the same topics. What are you seeing on your end?
Yeah, agreed. So we had our Memorial Day weekend. Hopefully, everyone enjoyed their weekend. Of course, we also respect all the men and women who served in the armed forces. Now, as far as the markets are concerned, yeah, it's been pretty slow. But the biggest things that are happening right now are all energies related. We got European leaders in the EU. They agreed on a future Russian oil ban embargo where they're going to cut off roughly 90%. But it's not happening immediately. This is more of an aspirational goal. So it's supposed to happen sometime later this year. Also, oil prices, they're soaring now. They've reached up to the highest levels we've seen since March, which of course was at the beginning of the invasion of Ukraine. And gasoline futures reached all-time highs within the last, I think, yesterday. The number was $4 and $4.08.86 or something like that. But this is for the futures, not for the gas that you pay at the pump. But the futures tell you what's coming, so that's like the baseline cost. And then, of course, everyone has to charge on top of that for local, delivery and demand, etc. And then we have China easing lockdowns, which is of course increasing the amount of energy consumption. So everything is energies, and of course we've been talking about this. In fact, let me jump to the Madison platform and
Wait, so
let's
let me just double
yeah.
check. Did you just say that futures have printed its highest price ever for a future
Yes.
barrel of oil?
Not for oil, but for gasoline. Oil prices are not quite at the all-time record, but they're getting close. The all-time record, if I remember correctly, was back in 2000. Was it 2000? Wasn't eight. It was after 2008. I forgot what year it was, but whatever the case may be, it was sometime between 2010 and 2012 or so. I believe that we hit our all-time high for oil, but don't quote me on that one because I forgot.
Ye-
but but as far as gasoline, for certain, that's it. I mean that we've never seen this before. Um,
s- So the pain at the pump isn't going away anytime soon.
No, it can't because with a tightening, the market was. I mean, it's important for people to understand the markets for oil were already tight before any of this Ukraine stuff happened. It was already the case. We already were seeing pump prices go up. Part of this has to do with infrastructure. OPEC is not able to pump out as much oil because the demand's increasing greater than their capacity for supply. We have all sorts of disruptions after the COVID crisis. We have oil that's not even able to come online because of other issues, maybe sanctions. So it's just so much going on with oil. So energy's companies, they're doing fantastic. In fact, pretty much every country out there I've seen, we haven't done it yet here, but a lot of countries are now going back to these energies companies and saying, "Hey, you got to pay us more taxes because your profits are so high that we need to take some of that money back."
So
so,
when looking at the market,
yep.
we've got some action in energies that's
Oh,
heading
for
to the
sure.
ups. Yeah. So what are we seeing here on the Madison Trading House
Right.
software analytical platform?
Perfect. So today, equity markets, the SPX currently is slumping, down about 1.23%. We can see like our 52-week high and low chart showing more lows. There's 43 stocks at 52-week lows and 27 at 52-week highs. But I can guarantee the ones at the highs are almost certainly energies companies. Let's take a look. So if we go to the energy sector, actually, let me just go to the sector view here.
Well, I'm
Uh,
only seeing one green. I'm
yeah,
only seeing
exactly. And
one
there it
green
is.
box.
Right. So that's it. So here's our energies, and we're looking at a list. And one of those stocks you probably recognize because we've been talking about this for a while, Conoco Phillips. Now, when we put out that alert, which was over a month ago. Conoco was trading in the low 90s, actually a little lower than that. So here we are today. It's currently at 115.50, up 2.79%. And it went up as high as 117.80. I think that was on Monday. And I remember a lot of people were asking in the broadcast that I do, well, is it possible it can go higher? And it's like, absolutely yes, because right now all the things that would be needed to push prices higher are there. So let's actually take a look at it on the chart too. So I'll go to the dashboard here, um, Conoco, and I could have actually just clicked on it to go here, but went the long route. But anyway, so here's Conoco, and if we look at it on the dashboard here, we've got 1.38% more institutional ownership. Money flow has mostly been filtering out for a while now, but you can see right here on the 31st, we see that little blip of green in the middle. And that basically means that we're seeing more buying. So on the 31st, we had basically a lot of people sell off because it was such a high price, 117, almost 118 a share. So it's not surprising a lot of people dumped shares, but I wouldn't expect that to be very long lived. So Conoco probably won't be the outperformer now. We have to look for stocks that are in the sector that are a little farther behind. This is one of the leaders. So we got into that early because the fundamentals shifted in its favor quicker. But then we also were able to find, or now I've been able to find some other stocks too. But for right now, just the summary here. Here's a Conoco on the chart, and by the way, I'll go over what this thing here is at the bottom is later on. But if we look at Conoco on the chart, we can clearly see the degree to which this has been going up. So ever since the end of 2020, we've been seeing a consistent trend up, getting closer and closer to that 120 mark, which it very well could hit. In fact, some analysts think it can go even higher. We still have the highest estimate at 160, but as you can see, right where we are now is the median, the midpoint of all the analyst estimates at 119.29. And this is one of the reasons I mentioned to people in the room that yes, I do think it can go higher. And the truth is, if the fundamentals change, oh, sorry about that, but I'll leave it alone. The light went out. But if the fundamentals change, we still could see higher prices even above where we are now because it all comes down to that. But I would say for the time being, expect this stock to find some resistance from going up any farther and look for some other stocks in the sector to potentially do better moves. So if we go back to the market view, and if we, why don't we just do this? Let's look at the sector scores or spectrum. So if we go to energies, here we can see the oil and gas, of course, and here we can see all the different companies. Here's Chevron, Conoco. We can see what they're doing. So Conoco has some pretty nice numbers, but there should be some other stocks that are in the sector. Like here's Fang, which is not a oil company, but there's Oxy. So there's quite a few in here that look like they're a little bit behind Conoco. So therefore, they probably are due for a rally. Like here's one. I'm sorry, I'm looking at sorry Exxon. Exxon is not up as much as Conoco, but we could see some more action there. So I would expect more people to start to gravitate towards lower price energies companies that still have some room to breathe and to go higher, and any ones that are kind of in the middle of the road where they have good fundamentals and they're starting to get some good technicals like Devon Energy. These are the ones that I think will be the more outstanding performers. So Devon is up, but I still think it has some room. Um, well, actually, it's right about where the analysts think it should go. But I do see that earnings are expected to be pretty good for next 2 quarters. And I also see huge earnings growth expected for 2022 and 23. So I wouldn't write this one off, even though right now the analysts are not looking for it to go much higher. Keep an eye on the fundamentals, and we probably will see some more upside soon for a lot of these
Yeah.
stocks.
Yeah, and that's the power behind this amazing software. If members or subscribers had been in tune with the group, that they might have caught that ConocoPhillips run. And you're
Right.
saying that it might still have some legs, but the majority of what it's done is basically in the rear view mirror. And one of
Right.
the amazing features of the software is that it allows you to analyze sectors, underperformers. And so
Right.
in the coming weeks, I'll be curious to see if the AI picks up any of these sleepers that
Right.
might be having to play catch up in the sector. So great insight, awesome action. Let's keep the show rolling. Um, how about the from an economic perspective? Now, oil is continuing to increase, which is applying that inflationary pressure. And
Right.
so, do we have anything in the pipeline that might move the market?
That's a good question. I mean, it's going to be tough. I mean, we got a lot of economic data coming out. We've got 80 for this week. We've got like 80 ADP non-farm employment change, unemployment claims. But we have FOMC member Brainard speaking on Friday. I think of all the things coming out, that's going to be the one that's going to have the biggest impact because unemployment and things like that right now they are important, but at the same time we have to take it all in context. So if the numbers are so horrible in unemployment that people think that the Fed's going to slow down, that may help boost the markets. But my guess is that the Fed won't slow down because I think they're extremely laser focused on getting inflation under control. And it makes sense because if we don't, it's going to have, we're going to push unemployment higher. It's going to push people out of jobs. We're already seeing. There was a stat I saw about the UK where I think 25% of small businesses in the UK, their expenses have been boosted so high, based on energies and other inflation, that they only have about 3 weeks of cash reserves to stay in business because they're actually running at a deficit, which is crazy. 25%. Like it can't be any better here because we're paying too. So I think that inflation is the biggest single enemy right now, and if it doesn't get underhand, everything else gets worse. So if anyone's thinking the Fed's going to back off and say, well, let's just not raise rates because we don't want to hurt companies, well, the companies are getting brutalized right now by inflation. So I think that's going to be the biggest thing. So let's watch what the excuse me, the Fed has to say, or Brainard, Federal member Brainard has to say on Friday. And we still want to keep an eye on what the economic data has to say just to get a sense for how the economy is going. But numbers have been mixed so far, and a lot of them are coming worse than expected. So, not expecting anything really good to come. We're probably going to see more disappointment as far as numbers are concerned.
Yeah, I feel like so Friday will be a big day in the employment numbers, and then we'll get some Fed chatter, and it being Friday, the a new month, a new quarter. Well, is it a new quarter? Yeah, right.
Yes,
Yeah,
technically, yeah, June.
right. So
Yeah,
there could be some shuffling of some money and things like that. So we'll keep an eye on that for Friday. The other news that I'm kind of keep hearing chatter, and a lot of our followers and fans have been engaged with, is this Amazon split. And so
right,
we talked about it a few weeks ago.
right.
And so I think we discussed that you have some more follow up, but also a little bit more insight into how a stock split like this works. I mean, a 20-for-1 stock split, that's pretty big news for a well-known name like Amazon.
That it is. So, as far as it goes, I have it up here on the Madison platform. I went over to the calendar, and the calendar just keeps track of different financial reports, like earnings, dividends, things like that. But as you see here, it says SPL, which is for split. Now you notice this on Saturday. Now we talked about this last time, but we got a comment on YouTube, which I believe the question or the comment was that the split's going to happen on Friday. Well, actually, the split actually happens on Saturday, but you have to be a stockholder of record on Friday, this Friday, to be able to benefit from the split. In other words, you have to hold shares over the weekend. If you sell your shares at the end of the day on Friday, well, you don't have any shares left. you've already liquidated. So therefore, come Monday, you don't have anything in your account. But the way the markets usually work, and this is true for options as well as for things like this, is that they're usually actually processed on the weekend. So let's say you had options that expire on Friday, which is the normal day that options expire. Once the day is done, the options have expired, but the actual settlement occurs on Saturday, the day after. So then once that's done, then everything is formally settled. So it's not to say that the split itself is going to happen per se exactly on Friday, but you have to be in the stock through the close. In other words, if you sell, just to point this out, if you were to sell your shares after the bell rings, again, same problem. You don't have your shares on Monday, so you don't benefit at all from the split. Now, come Monday, the shares are going to be trading roughly 1/20th of their current value. I say roughly because obviously when they're reopening, the quoted price could, in the pre-market might be a little different. Usually stocks don't open at the exact same price on Monday as they closed on Friday. So you may not see exactly precisely that, but it's going to be approximately a 1/20th the price of the shares. So if they're at $2,000 on Friday, then they're going to be worth $100 each on Monday, and you'll have 20 shares instead of one.
Well, that's close to the price that we're at. We're like 2,400.
Right, right. Yeah, so it's going to be pretty close. So was that 120 if I'm doing the math in my head correctly? But what's good about this is that it does increase demand for the stock. I mean, that's the whole idea of a split. So if you're doing a stock split, you're looking to increase participation in trading of your shares. Now, Amazon being in the thousands of dollars per share is very cost prohibitive. I mean, there are a lot of people who would not be able to trade Amazon because they may not have enough money in their stock portfolio to buy a single share, or if they could buy shares, maybe it's going to take up 10%, 20% of their portfolio. And even if you have a larger portfolio, it doesn't matter. It's still a big chunk of money to commit to one single share. So by dividing it up into 20, you make it much more easy to be able to maneuver in and out of the stock. So that means that instead of you having to buy this really big chunk, you can break it into smaller bits, making it a lot easier for you to trade. So this will definitely be attractive to the retail sector, the average trader, because that's going to make it more affordable. And once you can do that, then of course, if people are interested in Amazon, which I'm sure a lot of people would be, this makes it a lot easier to get into. But I will mention that fundamentally, and I did want to analyze this. Fundamentally, Amazon is still not looking so great, and I'll show you why. This is the bigger one. So earnings are reported, of course, every quarter. We were just talking about quarters, and for the quarter reporting for March 2022, we had an estimate that they would generate $8.73 a share earnings. Instead, we had 424, which is not good. So basically, Amazon missed big time, and what this means is that when we're looking at the next quarter to be reported, you can see like these numbers here, these columns. They represent what people were expecting 60 days ago, 30 days ago, 7 days ago, and at present. And what this means is that we have a sharp change in estimates of earnings. And of course, why? Because of the report. So, we had a fantastic um, earnings on this reporting here, where estimates were much lower than what came out. But of course, that I won't get into the details of what was going on there. But the point is, now everyone's expecting things to be less profitable, and that's based on what Amazon itself is saying. So it's not like the analysts are just pulling these numbers out of thin air. It's based on what Amazon itself is saying. Here's what we expect. So a lot of the problems come down to supply chain issues, cost issues, labor issues. All those things factor in, and a company like Amazon is not immune. So when you're dealing with companies like this, it's important to understand that their profit margins are usually not very large. So if your profit margins are like, 5%, 2%, which, is not a lot, but that's something that you might see for a Walmart or companies like that. Amazon is no different. Their profit margins, I have to check what their actual numbers are, but the point is the profit margins are not fantastically large. So therefore, when you have a sudden increase in price and costs, it bleeds over right away into your revenue. And therefore, the only way to offset is to increase prices, which of course makes people buy less. So it's kind of a catch 22. You have to increase the price to cover your costs, but if you do that, you actually reduce your revenue, and that's what we've been seeing. So analysts still have targets that are expecting Amazon to do well. The current midpoint target is about $3,700. Currently, we're at 2432, so that's about a 50% upside potential if they're right. Um, I would say with this one, I don't feel like it's a big risk to be in Amazon for the long term, but in the short term, I'd be careful about anything. Once the split occurs, once Monday hits, look at it then and we'll see if it looks like buyers are really flooding in. If they are, great. Then we can actually do something with it. But if I look at it right now, um, it's more top 10 list that makes sense. Amazon's down. A lot of times big funds buy when um, good stocks are down. But at the same time, that doesn't necessarily mean this is going to go up, right? They could just buy and say, all right, we're just going to hold and wait for a while and they'll be in it for years. Whereas if we're looking for a short term gain, we need something with a little more momentum. So if we start to see a clear shift where the fundamentals start to improve, which we won't know until the next earnings report, we won't know what the fundamentals are really doing. But we can also check out what the institutions are doing. If we notice that they really start to ramp up their buying going into that earnings, then probably that's telling us what they know is coming or what they think is coming, and that might be a better timing to get in. So I usually like to wait for signs that they want to buy, and then that's when I buy. I don't want to assume that, even if I'm right about the company, if they're not buying, it doesn't matter. It's not going up, right? So we gotta play the game the way it's played.
Yeah, and that's one of the amazing features of the software, the Madison Trading House analytics, trading software. There's so many things in this software that it's really hard for me to sometimes categorize. At the end of the day, if you're trading, if you're analyzing, this tool certainly helps you navigate all that. And so, what I'm going to do real quick is for anyone that's watching or listening for the first time that is interested in checking out the software for yourself, doing a test drive, getting a demo, I'm going to go ahead and add a link to the chat. Go ahead and sign up there, and someone from Mike's team will get in touch with you, get you all the information that you need to test drive the software for yourself. So we'll keep an eye on Amazon next week. We'll keep an eye on it probably until the next earnings report, which will be interesting because if they can get some profitability and some turnaround, then there's definitely upside with that new retail friendly price. Another name that I feel like I've been hearing a lot the past couple of weeks is Apple. I'm obviously a big, well, I don't know if it's obvious, but I'm a big Apple fan, big Apple user, Apple
Yep.
Watch, Apple iPhone. The AirPods not so much, right? Maybe they're just a little old. Um, but I'm curious on your about your thoughts on Apple. And in addition to this, we're gonna go into something called the chart score, right? So you
Yeah.
charting the score, and so you have these phenomenal scoring systems. And so I actually did know that you could chart the score. So I'm interested to learn more about that. What are you seeing in Apple, Mike?
Okay, so what we're seeing in Apple, fundamentally, it's a solid company that hasn't changed probably ever in ages. So Apple can reliably make money, et cetera. Valuation wise, it doesn't look so bad either. So I'm just looking at the scores here. So here's our valuation score, and it's showing that the trailing PE and forward PE both are in a modest territory. They're not at the lowest point, but they're not high. They're closer to the lower end than the top. Next, we have the peg ratio, which is kind of in between. It's not really fantastic. It's not fantastically good. It's not too much. It's just in the right lukewarm middle. Price to book is really good. That's actually solidly in the green, and then price to cash flow is also in the middle. So, in short, valuation wise, it's not a stellar value, but it's a decent value. And in a market where lots of things are getting hammered, anything that has a decent value looks even more valuable. So we can expect some buyers to actually start to come into this more than they have recently. Now, it is true that Apple has lost a lot of institutional ownership. It's actually down 7.13% in institutional ownership. Now, just keep this in mind. This does make sense because in the context, usually, if you got a stock that's really performing well and the market's taking a downturn, if you're a longer term investment firm, there's a good chance you're going to sell your profitable stocks to get them, to lock in your profits while you can, because you know everyone else is going to do the same thing. So if you don't see there's good potential in the near term for further growth, because you think economic conditions are not going to be so great, and that's logical, then it makes sense to take profits now. Why leave it alone when you already have the money on the table? So it's not surprising that we saw a lot of institutional selling over recently, but it doesn't mean that these guys are going to be out of this forever. They're going to come back to Apple because we know lots of funds still hold it. In fact, Apple's now in 26 more top tens than it was before in the last reading. So that means that more institutions have taken on positions that make this the larger position they're holding. Now, that again doesn't negate from the fact that we still have fewer institutions as a group holding it, but for those who are holding it, more of them have it in their top 10. Okay, so it is what it is. It's neither bad nor good. It just means that this is the current situation. But what is interesting is that when we track the actual order flow, remember the order flow is visible before institutions actually have to report that they purchase shares or they're in a particular stock or they sold a particular stock. So it takes a little time for them to report that, but whatever we see in the money flow, that's happening right now. So if I look at Apple overall, if I look at over the last 5 days, I can see more green bands, or at least larger green bands, than I can see these red bands. The red bands mean that you had more net selling than buying, and it's just showing me the net difference between the two. The green band in the middle means you had more net buying than selling. It's showing us the difference between the two. And you can see that these are fatter than the red ones. So that means that overall, we're seeing money flow in the positive direction over the last few days, and probably that's going to continue. So I'll keep monitoring that to see if that's still the case. But so far, it looks like we're starting to see some covert buying going on that will be reflected later once the reporting of positions comes out. Fundamentally, Apple is always looking good. It's not doing quite as well as it always has, but net income is up, sales are up, profit margins are slightly down, but everything else is up. If we look at cash flow, it's up. So, I mean, for the most part, if this is a business, of course it is, everything looks good, right? Score wise, they look fairly good on their numbers. Very good, actually, all things considered. And if we look at their earnings, Apple earnings are not projected to grow dramatically in 2022 or 2023. It's expected to be fairly consistent, but if we look at the targets, analyst targets have Apple on average at 187.60, highest is 205. Notice there's not a huge spread between the high and low point here, which means that this is probably where the stock's going to end up. So the greater the difference between the analyst estimates are, the more volatility you'll get in the stock. What this basically means is that the picture is clear. People can clearly see what's going on with Apple, which is not surprising. It's a very big company, is very well followed. It's an extremely valuable company. So therefore, confidence is fairly high that this stock will be able to get up to around 190 within the next 12 months. So at this point, with the stock um, currently not trending up, we're currently in a slump for Apple. If I expand the time, You can see that we've come down quite a bit from the recent highs, but that just makes it more attractive for those who are value hunters. And that brings us down to here. So this allows us to track the score over time. Notice that we have the 4 box score here. Well, the top column, or I'm sorry, row here is the technical score. So it's just showing the history of technicals. Notice that it's more variation on that part. Charts tend to change a lot more. But when you look at the fundamental at the bottom, which is the same thing as this 3 bar here, that row, which is solid green almost from one side to the other with a very brief blip of yellow, but that basically means that, as far back as we can see on this chart, Apple's had absolutely rock solid fundamentals. It's been consistently gaining revenue, consistently gaining sales, consistently getting better cash flow, consistently doing better financially. So that's why you've seen Apple stock go up so much over the years, because anything that's a cash cow should be. Now, what is interesting though is if you look at the valuations, a lot of times Apple's been in the yellow, which basically means it's not so great of a value, but it's not so bad of a value either. But as of right now, we actually just now, roughly, let's see what the date was on May the 13th. So it's, earlier last month, we actually crossed over into the green for valuation. Now, it's no secret. Institutional investors love to look at valuations. They love to compare one metric to another. So, how's the price compared to the cash flow? How's the earnings compared to the price? How's the book value compared to the price? These are logical things to do because what they're trying to do is figure out at what place is the stock at a value point. Then our software knows that instead of it using some sort of archaic idea that um, only one P ratio or lower is good, it looks at it relatively. It says for people who buy Apple, which is a lot of the market, lots of funds buy Apple. Where do they usually buy it? At what value points? So by tracking all these value points, we're able to get a sense of when they're likely to come in. And that's why I'm saying now that we've passed into that green zone, and this is the first time we've done that in a while. The last time we did that was back in August, July, late July, early August of 2021, which on the chart was right about there. And if you notice, after a while, price starts to appreciate after that. So I can't say for sure price is going to go up. No one can. But what I am saying is that if we're going to look for places where buyers usually come in, well, that's usually where they come in. And also, we should also keep in mind that we can keep track of institutional activity, so we can see that there was a lot of buying going on from about February this year all the way until oops, sorry, all the way until um, May of this year. But we did have some selling, as I mentioned at first, but I do think that we're going to see some buyers coming in pretty soon. So we have to wait. I always say wait until it's pretty clear that the buyers are coming in. But if you're a long term investor and you're willing to take a small risk, reasonably speaking, you should be rewarded for buying Apple when it's at a good value point. And eventually, the rest of the market follows suit. So we'll see what happens. But I do think that realistically, Apple's probably at a good value point right now.
I really love the visualization of the score, and I'm so glad that we were able to dig into that because it really does help bring light to what they mean, right? And I feel like that what we're looking at now in Apple is like an amazing setup, right? Like
Hmm.
the values there, the company's making a lot of money, but technically they've fallen off. Some of the institutional buyers have fallen off, but that's good. Like that's what you want in a setup for a stock. And so two green, one red, one yellow has the potential to be all greens, especially with an innovative company like product or like Apple, we never know what's coming down the pipeline.
Right.
Like they could have a new product, a new tool, and that could really impact the future value of the company. But ultimately, at the end of the day, they make a product that people love, and you just need to find technically where it's a good point and decide, well, how long do you want to hold it?
Right.
But great view, Mike.
Yep.
Loving the charting and the score. And just quick question: you can chart the score for any symbol, is that correct?
That is correct. Any symbol. So if I go to Divine Energy, if I go to Conoco Phillips, we can see its score. When you pull up ETFs, since they don't actually have cash flow and things like that, the bottom two scores don't matter for ETFs because for us to actually calculate a valuation, we would need to have, um, actual cash flow and things like that. So the top numbers we can calculate the insider score because we can see if institutions are buying or selling an ETF, and we can of course track the technicals. And as we saw in that sector map, if we want to look at the components of a particular sector, we can do that too. That allows us to basically use the scores of those stocks, like it does in that spectrum model, to give us a summary of what the sector is doing as a whole. So, in a sense, it's a way to get the information on the score without actually having to use the score.
Yeah, phenomenal.
Yep.
Phenomenal. So, anyone watching, listening for the first time, if you want to test drive the software, head on over to the chat. The link will be there. If you have any specific questions, feel free to leave them in the chat, in the DM. Send the team an email. I know they're always more than willing to help answer anything and everything that comes up. Wonderful. So with that, we're going to go ahead and close the show out. Mike, any final words? We're going to be keeping an eye on um, employment. We got some Fed chatter. Any summer advice since we are going to be heading into the beginning of summer?
Only summer advice is stay cool. That's it. But as far as it goes, keep an eye on the energies. That's where I'm just saying that's where a lot of the action is going to be, and then also in industries that tend to grow with inflation, which are not that many, but some kinds of food, producers, those companies typically do well as well when inflation is high because obviously if you produce wheat, you can sell it for a higher price. If they're involved in the import export, it's a little questionable because their fees for transport go up and doesn't necessarily mean they can offset it with probably they're just going to break even with the offset to the higher grain price. So it's basically the producers who have the lowest impact from fuel prices, but the highest return on investment. Otherwise, those are going to be the ones that do the best. So I'll keep an eye out for those, like a Archer Daniels Midland or something like that. Those are companies that typically can do well. Just stay away from anything that's very sensitive to inflation because it's not going away. So I would steer very clear of that, especially during the summer.
Awesome. And so if anyone's looking for some more in-depth analysis, opportunities. I know that every member who comes onto the platform has the ability to chat and communicate and come up with ideas. So if you haven't tested out the software, hit that link, test drive it, let us know what you think. I know that from my experience, it certainly has helped me. And I hope that it can bring value to, all the new traders or even the old traders out there. And so I'm looking forward to seeing the feedback and the commentary. Otherwise, if you like the show, feel free to hit that follow, that subscribe, smash that like button, and we'll continue to try and bring you the best content possible. Big thanks to Madison Trading House for helping, the world of traders become more profitable. Otherwise, everyone, thank you for your time. We'll catch everybody next week. Adios, guys.
Take care, everybody.